Viewers at home, you are welcome to my presentation on IAS 1, presentation of financial statements. IAS 1, presentation of financial statements. IAS 1, presentation of financial statements. In this presentation, I want to provide a further work example to complement my earlier presentation using question from ICANN November 2021, financial reporting question number 1. If you are just coming across this YouTube channel for the first time, or if you have not subscribed in the past, please click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. IAS 1, presentation of financial statements. Now the question. The trial balance for United Nigeria PLC as at December 31st, 2020 is given below. We have the debit side and the credit side, amounting 1,000. We have revenue stroke purchases 300,000 and 680,000. The 300,000 is for the purchase, while the 680,000 is the revenue. Inventories as at 1st of January 2020, that is 80,000. That is the opening inventory. Property, plant and equipment at cost as at 1st of January 2020, we have the 950,000. Property, plant and equipment accumulated depreciation as at 1st of January 2020, and that amounted to 390,000. The interest on 10% loan notes as at 30th of June 2020, that is 5,000. This is half-year interest. Half-year interest on loan notes has been paid. Remember, the accounting year end is December 31st, 2020. The interest up to June 30, 2020 has been paid. That means interest for the period of July 2020 to December 2020 has not been paid. We have discounts, 10,000 and 8,000. The 10,000 is the discount allowed. The one at the debit side is the discount allowed, while 8,000 at the credit side represents the discount received. Distribution expenses, that is 80,000. Retained earnings, we have 252,000. We have administrative expenses, that is 75,000 naira. Bank balance of 160,000. Bad debts written off, and that amounted to 12,000 naira. 12% preference shares, and that is 120,000 naira. 10% loan notes, and that amounted to 100,000 naira. Ordinary share capital of 50 kobo each, and that amounted to 150,000 naira. We have the share premium, and that amounted to 90,000 naira. We have returns, 8,000 and 6,000. The 8,000 at the debit side represents the return inwards, while the 6,000 at the credit side, that is the return outwards. The allowances for trade receivables, and that amounted to 10,000 naira. Trade receivables and payables, we have 360,000 and 234,000. The 360,000 is the trade receivable and 234,000 at the credit side, and that is the trade payable. The total of the debit and credit side is 2,040,000 naira respectively. Then we have the additional information. Inventories as at the end of the year. Inventories as at the end of the year were 1.2 million naira. Inventories as at the end of the year were 120 million naira. Were 120 million naira. Included in the closing inventories was damaged item with a cost of 30 million naira, which has a net realizable value of 18 million naira. Remember, in accordance with IAS 2, inventory should be measured at the lower of cost or the net realizable value. So, note 2, additional ordinary shares of 50 million were issued and fully paid for at 80 kobo per share. This is yet to be recorded in the trial balance. Note 3, interest on 10% loan notes is outstanding and dividend on 12% preference shares were paid on December 31st, 2020. Existing ordinary shareholders were paid dividends of 5 kobo per share on December 31st, 2020. These were yet to be recorded in the trial balance. These were yet to be recorded in the trial balance. Note 4. Allowances for trade receivables are to be increased to 15% per annum. Depreciation is charged on plant and equipment, that is PPE, at the rate of 15% on reducing balance basis. Note 5. 5 million naira administrative expenses were outstanding, and 25 million naira company income taxation is estimated for the year. Depreciation is charged to administrative expenses. So, the requirement. You are required to prepare the following. You are required to prepare the following. So, A1, statement of comprehensive income. Statement of comprehensive income of United Nigeria PLC for the year ended December 31st, 2020. A2, statement of changes in equity for the year ended December 31st, 2020. A3, statement of financial position as at December 31st, 2020. That is the question. So, now we have the applicable standards. The following standards, applicable standards. The following standards were examined in the question. Number 1, IAS 12, income tax or income taxes. Income taxes were tested in the question. Number 2, IAS 16, property, plant and equipment. Property, plant and equipment were tested in the question. Number 3, IAS 32, financial instruments. Presentation were examined in the question. Number 4, IAS 2, inventories. These are the standards that were examined in the question. Now, let's have the solution. Back to the question. The trial balance of United Nigeria PLC as at December 31st, 2020 is given below. The first thing should be the name of the entity. The name of the entity, which is United Nigeria PLC. United Nigeria PLC. Now have statement of comprehensive income. Statement of comprehensive income for the year ended. December 31st, 2020. So, that is the question. All amounts are in thousands. So the first item is revenue. The first item should be revenue. Back to the question. In the trial balance, we have revenue stroke purchases. At the debit side, you have 300,000. The 300,000 at the debit side represent the purchases, while 680,000 is the revenue. Then if you also go through the trial balance, you have the returns of 8,000 and 6,000 respectively. The 8,000 represents the returning was, while the 6,000 represents the return out was. Returning was of 8,000 should be subtracted from the revenue, while the return out was of 6,000 should be subtracted from the purchase. So now revenue of 680,000 minus the returning was of 8,000 at the debit side of the trial balance. So that will give us 672,000. After the revenue, the next item should be the cost of sales. For better understanding, I will advise you go over my earlier presentations on IAS 1. I have some videos, up to 4 or 5 videos on IAS 1, which I have presented in the past. Please go over that for better understanding. Now, let's have the cost of sales. Working 1. Cost of sales. Cost of sales. So, the first item should be the opening inventories. Opening inventories. And that will be obtained from the trial balance. If you go back to the trial balance, you have inventories as of 1st of January 2020, and that amounted to 80,000. That 80,000 is our opening inventory. So we have 80,000. After inventory, the next thing is purchase. Your purchases, you have your purchase. If you go back to the trial balance, you see the purchase of 300,000 naira. 300,000 naira, that is our purchase figure. So, if you put 300,000 as your purchase, then from purchase you less the purchase return. Less purchase return, that is the return out to us. You less the return out to us. Back to the trial balance. At the credit side, you know you have returns. 8,000 at the debit side represents the returning was, while the 6,000 at the credit side represents the return out to us. So we are going to subtract the return out to us, which is 6,000 from our purchase. Now we have less the purchase return or return out to us of 6,000. If you subtract 6,000 from 300,000, then you have 294,000. Now if you now have 80,000 plus 294,000, then you have 374,000. Then after purchases has been considered, now let's consider our closing inventories. Remember the measurement of inventory in accordance with IAS 2, that inventory should be measured at the lower of cost and net realizable value. So, less closing inventories. Less closing inventories. We have the cost. Back to note 1. Inventories at the end of the year were 120 million naira. So the cost of the inventory is 120 million naira. Included in the closing inventories was damaged item with a cost of 30 million naira, which has a net realizable value of 80 million naira. Remember, in accordance with IAS number 2, inventories should be measured at the lower of cost or the net realizable value. That means we have to write down 30 million has been included in this inventory. We have to write down the 30 million to 80 million naira. So now we have the cost, which is 120 million. So we now have damaged inventory or damaged item. So the cost is 30 million. And the net realizable value The damaged item, we have that cost 30 million. And the net realizable value of that, net realizable value is 80 million. Remember, this 30 million has been included in the 120 million. So that means you want to write down the 30 million included in the 120 million to the net realizable value of 18 million. Therefore, you have 30 million minus 18 million. That will give us 12 million. You are going to write down your closing inventory by 12 million. So that will be 120 million minus 12 million. And that will give us 108 million. Alternatively, you can just put the closing inventory of 120 million minus the 30 million which has been included, which has damaged. Then you add 80 million. You know, the cost of the entire inventory is 120 million. The damaged one is 30 million. If you have 120 million minus 30 million, that will give us 90 million. If you now add the net realizable value, the amount this 30 million can be realized, which is 80 million. If you now add it, then you have 108 million. So, inventory should be measured at the lower of cost or net realizable value. Therefore, what will now be our cost of sales? Our cost of sales, that is, you have 374,000. 374,000. Know our cost of sales. We have cost of goods available for sale, which is 374,000 minus closing inventory of 108,000. Then you have the cost of sales to be 266,000. 266,000. That is our cost of sales. So you now insert the 266,000 to your cost of sales. So we have minus 266,000. If you now subtract cost of sales from revenue, then you have 672,000 minus 266,000. Then you have 406,000. The 406,000 represents our gross profit. Gross profit. After gross profit, the next item is the distribution cost. Now let's go through the trial balance. We have discounts. This is discount allowed and discount receipt. You can treat your discount allowed as part of your distribution expenses. Then we also have distribution expenses of 80,000. So we want to consider the discount allowed of 10,000 and distribution expenses of 80,000. Now let's put down that working tool. Distribution costs. So we have the discount allowed. Discount allowed of 10,000 naira. And then we also have the general distribution expenses of 80,000 naira. Now, let's go through the trial balance. We have bad debts written off, and that amounted to 12,000 naira. Bad debts. Written off, and that is 12,000 naira. Now let's go through the trial balance to see if there is any other one to be considered. So, preference shares, loan notes, ordinary shares, share premium returns, allowances for trade receivables and trade payables. Now let's go through the footnote. Additional information. Note 1 is inventories. Inventories. Note 2, ordinary shares. Note 3 is interest on loan notes and the ordinary shares. Note 4 allowances for trade receivables are to be increased to 15% per annum. Depreciation is charged on plant and equipment at the rate of 15% on reducing balance basis. And the last note, you are to charge your depreciation to administrative expenses. So, you are to increase your allowances for receivable to 15%. Now, let's consider that. Increase in allowance for receivables. Increase in allowance for trade receivables. So we have the old balance, old provisions or old allowance. The old allowance is the one given in the trial balance. The one given in the trial balance is the old one. And the new one is the one given in the note. Remember, you have to increase it to 15%. The old allowance, we were told allowances for trade receivables is 10,000 naira. And that amounted to 10,000. So the old one now is 10,000. Then the new allowances for trade receivable is 15%. 15% of your trade receivables balance. If you go back to your trial balance, you will see the trade receivables. You were given trade receivables and payables, 360,000 and 234,000 respectively. The 360,000 represent the trade receivables. So you calculate the 15% of that 360,000. Calculate 15% of the 360,000. 360,000 times 15%. That gives us 54,000. That is to show that the allowances for trade receivable has increased from 10,000 to 54,000. That means it has increased by 44,000. So when you sum it up, so your distribution cost 10,000 plus 80,000, that is 90,000. 90,000 plus 12,000 plus 44,000, then you have 146,000. 146,000. So our distribution cost is 146,000. 146,000 naira. The next item is administrative expenses. Administrative expenses. Let's have that as working 3. Working 3. Administrative expenses. Now, back to the trial balance. Now, if you go through the trial balance, now let's see if there are any expenses that will be charged to administrative expenses. We have the revenue, inventory, property, plant and equipment, and accumulated depreciation. We have interest on loan notes, discount. The discount at the debit side is the discount allowed, while the discount at the credit side is the discount received. Now, you are going to deduct the discount received from the administrative expenses. And the discount received is 8,000 naira. You are going to deduct that. You deduct the discount receipts of 8,000 naira from administrative expenses. Now, in the same trial balance, we have administrative expenses of 75,000 naira. Administrative expenses, let's have it as general admin expenses. General admin expenses that amounted to 75,000 naira. 75,000 naira. Now, back to the same trial balance. So, we have bank balance, that is an asset. Bad debts written off, that has been considered earlier. Then we have the 12% preference shares, that's a liability. 10% loan notes is a liability. Ordinary share is an equity. Share premium is equity. Returns has been considered. Allowances for trade receivables has been considered. Then trade receivables and payables, that is an asset and liabilities respectively. Back to the footnote. Then inventories. So then ordinary shares, additional ordinary shares of 50 million were issued. This is all about issue of shares. Interest on loan notes, outstanding, and dividend. This is about outstanding loan notes and dividend. Then note 4. Allowances for trade receivables, and that has been considered. Note 5. 5 million administrative expenses were outstanding. Now we have outstanding admin expenses. That is accrual. So we add it. Outstanding means accrual. The one due, not yet paid. Now, back to that same note 5. 5 million administrative expenses were outstanding, and 25 million company income taxation is estimated for the year. Depreciation is charged to administrative expenses. You have to charge the depreciation to administrative expenses. If you go back to the note 4, you were told that allowances for trade receivables are to be increased to 15% per annum. Depreciation is charged on plant and equipment at the rate of 15% on reducing balance basis. So where depreciation is charged on reducing balance, that means you are going to calculate the depreciation on the carrying amount of an asset. So under the reducing balance method of depreciation, depreciation will be calculated on the carrying amount of an asset. The carrying amount of an asset is the cost of the asset less accumulated depreciation to date. Now, depreciation on plant and equipment, depreciation on plant and equipment. We were told 15% on reducing balance. The reducing balance, I've told you that you calculate depreciation on the carrying amount of the asset, which will be the cost of the asset less accumulated depreciation to date. Now, the property, plant and equipment cost is 950,000. This is the cost of the property, plant and equipment. And you were equally told that property, plant and equipment accumulated depreciation, that is 390,000. So you now subtract the accumulated depreciation of 390,000 from the cost to arrive at the carrying amount, upon which depreciation of 15% will be calculated. Now, the cost is 950,000 less accumulated depreciation of 390,000. Then, if you subtract that, then you apply 15% on the carrying amount, then you have the depreciation of 84,000 naira. 84,000 naira. So now, you are going to sum it up. Let's sum it up. Minus 8,000 plus 75,000 plus 5,000 plus 84,000. Then you have administrative expenses to be 156,000. 156,000. Then we are going to charge 156,000 as our administrative expenses. After administrative expenses, the next item will be our finance cost. Finance cost. Finance costs are interest-related items. Interest-related items are said to be the finance cost. Anything pertaining to interest is what we are going to charge as our finance cost. Now, back to the note. Note 3. Interest on loan notes is outstanding. Then we have note 4. We have finance cost. We have interest on loan notes. Interest on loan notes. You were told interest on 10% loan notes is outstanding. 10% of the loan notes. Back to the trial balance. We have 10% loan notes, and that is 100,000. 10% loan notes is 100,000. 10% of 100,000, and that will give us 10,000. The interest on loan notes is 10,000. But if you go to the trial balance, You were given the loan note interest on loan notes as at 30th of June 2020 to be 5,000. Remember, the total interest due on loan notes to date is 10,000. Then, out of this 10,000, 5,000 has been paid up to June. If 5,000 has been paid, then that means the remaining 5,000 remain unpaid. The one that remain unpaid, which is 5,000, will be recognized as a current liability in the statement of financial position. Now, aside the loan notes, you were told, and dividend on 12% preference shares were paid on December 31st, 2020. Dividend on 10% preference shares were paid. Now, preference shares dividend. Preference shares dividend, which is 12% preference shares. The 12% preference shares given in the trial balance is 120,000. 120,000. 12% preference shares, 120,000. Then if you calculate 12% of 120,000, 12% of 120,000, then you have 14,400. These 14,400 were paid according to the note 3. This, I were told that were paid, and dividend on 12% preference shares were paid on December 31st, 2020. Existing ordinary shareholders were paid dividend of 5 kobo per share on December 31st, 2020. These were yet to be recorded in the trial balance. They were yet to be recorded in the trial balance. So, when you sum it up, you have 24,400. 24,400. That 24,400 is our finance cost. 24,400. So, you now subtract all those items, you subtract them from the gross profit. So that means you have the gross profit of 406,000 minus 146,000 minus 156,000 minus 24,400. Then you have 79,600. This 79,600 represents the profit before tax. The next item will be the tax information. We have income tax expense. Income tax expense. Now, let's go through the trial balance to see if there is any information about tax. Information such as the under provision for income tax or over provision. So, go through the trial balance. There is no tax information. No tax information is given in the trial balance. Now, back to the footnote. Back to the footnote, note 5. Note 5. You were told that and 25 million company income taxation is estimated for the year. 25 million company income taxation is estimated for the year. So the income tax expense is 25 million. So if you subtract 25 million from 79,600, then you have 54,600. 54,600. That is the profit for the year. Profit for the year. That is profit for the year, and there is no items of other comprehensive income in this question. No revaluation gain, since there is no revaluation gain or deficit. No gain on fair value measurement of an asset that are held for trading in accordance with IFRS number 9. Since there are no such information, that means this is where our statement of profit or loss is going to end. Then the next item will be the statement, or the next section will be the statement of changes in equity. Now, United Nigeria PLC, that is the name of the entity. United Nigeria PLC. So we have statement of changes in equity for the year ended. For the year ended December 31st, 2020. Now, let's have the total. Back to the trial balance. Let's identify the component of equity. The component of equity given in this question. Number one component, we have ordinary shares, then followed by share premium, and then we also have retained earnings. So I think we have three components of equity. Now 1, 2, and 3. The first one is ordinary shares. Ordinary share. The second one is share premium. The third one is retained earnings. And we have total. Naira and triple zeros. Now, the first thing is the opening balance. Opening balance. This will be given in the trial balance. Opening balance brought down. Now, let's go back to the trial balance. So, in our trial balance, we have retained earnings, 252,000. That is the opening balance of our retained earnings, 252,000. So, we put that under the retained earnings, 252,000. We put it under the retained earnings. Now, back to the trial balance. So, we have ordinary shares, ordinary share capital of 50 kobo each, and that is given to be 150,000. The opening balance of ordinary share capital is 150,000. Then we also have share premium. Share premium of 90,000. Share premium of 90,000. We now sum up the opening balances. 150,000 plus 90,000 plus 252,000. The total is 492,000. 492,000. Then the next item is the profit for the year. From our statement of comprehensive income, we have profit for the year of 54,600. Profit for the year. That will be included in the retained earnings section. 54,600. So we also have it in the total. 54,600 to be included in the retained earnings. Now, back to the footnote. Additional information. Now, note 3. Interest on 10% loan notes is outstanding. Remember, loan notes is not part of equity. And dividend on 12% preference shares were paid on December 31st. This is preference shares. The preference dividend have been included as part of our finance cost. Existing ordinary shareholders were paid dividend of 5 kobo per share on December 31st, 2020. These were yet to be recorded in the trial balance. How much is the dividend paid to the existing ordinary shareholders? Now, let's calculate that dividend paid now to the existing ordinary shareholders. To calculate the dividend paid to the existing ordinary shareholders, you have to calculate the number of EU ordinary shares. Back to the trial balance. The EU ordinary shares is 150,000. 150,000. And it is denominated as 50 kobo each. The par value is 50 kobo. So that means the number of EU ordinary shares will be 150,000 divided by 50 kobo, 0.5. That will give us 300,000 shares. That is the shares in EU. Then this 300,000, you now calculate the dividends on that shares. So we have how much is the dividend paid. You were told dividend of 5 kobo per share. Dividend of 5 kobo per share on December 31st. That is, ordinary shareholders were paid dividend of 5 kobo per share. So dividend paid now. Notice is the number of outstanding ordinary shares. I mean, this is the number of EU ordinary shares. So dividend paid now. Dividend paid. That is 5 kobo, which is 5 over 100 times 300,000. And that will give us 15,000. The amount of dividend paid is 15,000. The dividend will be paid out of retained earnings. So we have dividend paid. Dividend will be paid out of the retained earnings. So under the retained earnings, so you have the 15,000. So subtract it from the total as well. Back to note 2. Additional ordinary shares of 50 million were issued and fully paid for at 80 kobo per share. This is yet to be recorded in the trial balance. So we now have the proceeds. Proceeds from issue ordinary shares, which is 80 kobo, and 50 million ordinary shares were issued. That will give us 40 million naira. Then the par value of ordinary share issued. Back to the trial balance. You have ordinary share capital of 50 kobo each. That is to show that the par value of ordinary share is 50 kobo. So we have 50 kobo times 50 million. And that will give us 25 million naira. The premium on shares EU will be close to the share premium account. Share premium. You know, the proceed is 80 kobo and the par value is 50 kobo. The difference between 80 kobo and the par value, which is 30 kobo, is share premium. That is 30 kobo of 50 million shares. And that will give us 15 million naira. So, we now have issue of shares. The par value, which is 25 million, to be included in ordinary share. The premium of 15,000 and the total 40,000. So, you now sum it up. You have the balance as at December 31st, 2020. 150,000 plus 25,000, that will give us 175,000. 90,000 plus 15,000, that will give us 105,000. Then 252,000 plus 54,600 minus 15,000. Then you have 291,600. 291,600. Then 492,000 plus 54,600 minus 15,000 plus 40,000. Then you have 571,600. 571 600. That is all about the statement of changes in equity for the period. The next thing is the statement of financial position. You have 3. United Nigeria PLC. Statement of financial position as at December 31st, 2020. The first thing should be assets. Then we start with our non-current assets. Non-current assets. Our non-current assets include property, plant, and equipment. Property, plant, and equipment. Let's have that as note 5 or working 5. So now, working 5. Property, plant, and equipment. How much is the cost of the property, plant, and equipment? Back to the trial balance. You have property, plant, and equipment at cost 950,000, and property, plant, and equipment accumulated depreciation 390,000. The cost is 950,000, while depreciation is 390,000. So cost 950,000. Then we have depreciation. Depreciation, balance brought forward, which is 390,000. How much was the depreciation charged as an expense in the statement of profit or loss charged for the year? Go back to working on administrative expenses. Administrative expenses, I think that is working 3. If you go back to the working 3, you see the depreciation that was charged for the year, to which amounted to 84,000 naira. Remember, depreciation was to be calculated on the carrying amount, that is the cost less accumulated depreciation to date. Then if you add up the depreciation, 390,000 plus 84,000, then you have 474,000. 474,000. Now, if you subtract 474,000 from 950,000, this is 950,000. Then you have 476,000. 476,000. That 476,000 is our property, plant, and equipment to be written in the statement of financial position. After non-current assets, the next thing should be the current assets. Current assets. Our current assets include inventories. Remember, inventory is to be measured at the lower of cost or net realizable value. Lower of cost or net realizable value. Note 1. Inventories as at the end of the year were 120 million naira. Included in the closing inventories was damaged item with a cost of 30 million naira, which has a net realizable value of 18 million naira. In accordance with IAS 2, inventory is to be measured at the lower of cost or net realizable value. Let me have that as working 6. So, the cost of inventory is 120 million. And we also have damaged items of inventories with the cost of 30 million naira. And the net realizable value of the damaged item is 18,000. That means inventory has been reduced by 12,000. If you subtract the 12,000 from 120,000, you'll be left with 108,000. That is our inventories. So we are going to have our closing inventory to be 108,000. 108,000. After inventories, we have trade receivables. Trade receivables. Let's have that as note. We are taking inventory to be working 6. So this will be working 7. Trade receivables. Now go through the trial balance. You have trade receivables and payables. 360,000 and 234,000 respectively. The 360,000 is our trade receivables. Remember, we are going to deduct the allowances for trade receivable from our trade receivables. Note, working 7, working 7. So trade receivables. So you have the balance as per trial balance. Balance as per trial balance. The balance of trade receivables as per trial balance is 360,000. 360,000. That is the balance of trade receivables. 360,000. So we have 360,000. Now less allowance for trade receivables. Allowance for trade receivables. Back to the note. Note 4. You have allowances for trade receivables are to be increased to 15% per annum. So 15% of 360,000. 15% of 360,000. That will give us 54,000. We have 54,000. If you subtract 54,000 from 360,000, the net amount will be 306,000. 306,000. 306,000. You have 306,000. After trade receivables, the next item will be cash and cash equivalent. Cash and cash equivalent. Let's have that to be working 8. Cash and cash equivalent. Working 8. Working 8. We have cash and cash equivalent. Then back to the trial balance. We have bank balance. Bank balance of 160,000. Bank balance of 160,000. So bank balance of 160,000. Now, back to the note. Note 2. Additional ordinary shares of 50 million were issued and fully paid for at 80 kobo per share. This is yet to be recorded in the trial balance. The proceed from the issue of ordinary share is 80 kobo multiplied by 50 million. Since it's yet to be received. When shares are issued, money will be received upon the issue of the shares. The amount received now, proceeds from the issue of ordinary shares, which is 50 million times 80 kobo. 80 kobo is 80 over 100, and that will give us 40 million. Note 3. Interest on 10% loan notes is outstanding, and dividend on 12% preference shares were paid on December 31st, 2020. The interest on loan notes is outstanding. Since it is outstanding, that means that interest has not been paid, so it remains as accrued. And dividend on 12% preference shares were paid on December 31st, 2020. Since dividend is paid, that means it will result in an outflow of cash. Existing ordinary shareholders were paid dividend of 5 kobo per share on December 31st, 2020. This were yet to be recorded in the trial balance. So now the dividend paid on preference shares and ordinary shares dividend now, which have been paid but not yet included in the trial balance, we are going to adjust them in cash from our cash and cash equivalent. So preference dividend paid, that is 12% multiplied by how much is our preference shares. You go back to the trial balance. Let's go back to the trial balance. So we have 12% preference shares, 12% preference shares, and that is 120 million. So that means the preference dividend paid now will be 12% of 120 million. So if you calculate 12% of 120 million, that will give us 14.4 million. Since dividend was paid, that means that will result in an outflows of cash. It will result in an outflows of cash. Existing ordinary shareholders were paid dividend of 5 kobo per share on December 31st, 2020. These were yet to be recorded in the trial balance. So we now have ordinary shares dividend. Ordinary shares dividend. Dividend of 5 kobo multiplied by the number of ordinary shares issued. Now, we want to determine the number of ordinary shares issued. Now, how much is the issued ordinary shares? Ordinary share capital of 50 kobo each, 150,000. Note the par value is 50 kobo. So, since the proceed is 150,000 divided by the par value of 50 kobo. So, if you have 150,000 divided by 0.5, that will give us 300,000. 5 over 100 times 300,000, that will give us 15,000. Ordinary shares dividend paid is 15,000. So you deduct it because it will result in an outflows of cash. Now we now have 160,000 plus 40,000 minus 14,400 minus 15,000. Then we have 170,600. Therefore, our cash and cash equivalent is 170,600. So, back to our current assets. So, cash and cash equivalent is 170,600. So, when you sum it up, plus 306,000 plus 108,000. So we have 584,600. 584,600. That is our total current assets. Total current assets. You now add the current assets and the non-current assets. We have the non-current assets of 476,000. 476,000. So when you sum it up, 476,000. That is current assets plus the non-current assets. So we have 1,060,600. 1,060,600. That is our total assets. Total assets. So having arrived at our total assets, the next section is the equity and liabilities. Equity and liabilities. Now, let's have equity and liabilities. So we are starting with our equity. Back to the statement of changes in equity. The first item is ordinary shares. And our ordinary shares is totaled 175,000. So we have ordinary shares of 175,000. Then the next item is share premium. Our share premium is totaled 105,000. Share premium of 105,000. Then after share premium, we have retained earnings. Our retained earning is totaled 291,600. So we have retained earnings, which is 291,600. So we now sum up our equity. That is ordinary shares of 175,000 plus share premium of 105,000 plus retained earnings of 291,600. You have the total equity to be 571,600. 571,600. That is our total equity. 571,600. After total equity, the next item should be our non-current liabilities. Non-current liabilities. So back to the trial balance. So our non-current liabilities include 12% preference shares of 120,000. 12% preference shares, 120,000. So we have 12% preference shares, and that is total 120,000. Then we also have 10% loan notes. 10% loan notes. That is total. That amounted to 100,000. 10% loan notes. That amounted to 100,000. If you add up 120,000 and 100,000, you have 220,000. That is our total non-current liabilities. Total non-current liabilities. After non-current liabilities, the next item should be the current liabilities. Current liabilities. Back to the trial balance. Current liabilities. The last item is trade receivables and payables. Trade receivables is 360,000 and trade payables is 234,000. So 360,000, 234,000. So the trade payable is 234,000. We have trade payables of 234,000. Trade payables of 234,000. Yes, what are other items that can be recognized as current liabilities? Now, back to the note. The note. So you were told that 5 million administrative expenses were outstanding and 25 million company income taxation is estimated for the year. So we have provision for income tax. Provision for income tax, that is 25 million. 25 million. Then we also have other payables. Other payables. Now let's have that as working 9. Working 9. Other payables. Working 9. Working 9. We have other payables. Back to the notes. Note 3. Interest on 10% loan notes is outstanding and dividend on 12% preference shares were paid. This one has been paid. The preference dividend has been paid. That means that one does not remain as liability. Existing ordinary shares were paid since the ordinary shares dividend were equally paid. So that means that will not equally remain as liability. The only one that is outstanding that will be recognized as liability is interest on loan note, 10% loan note. We are outstanding loan notes interest 10%. And how much is the entire loan notes? How much? Back to the trial balance. We have 10% loan notes, and that is 100,000. If you calculate 10% of 100,000, then you have 10,000. That is the loan notes interest. Loan notes interest that is due during the year. But back to the trial balance. You have interest on 10% loan notes as at 30th of June 2020. That amounted to 5,000. That means of the loan notes interest, half year interest, that is interest from the beginning of the period, which is January 2020 to June 2020, has been paid. That means half year interest has been paid. So you now remove the one that has been paid. Remember, the loan notes interest due is 10,000. From the 10,000, 5,000 has been paid. That means the one that remains unpaid is 5,000. That is 10,000 minus 5,000. Then you have 5,000. That is the outstanding loan notes interest. Back to the footnote. Note 5. Note 5. 5 million administrative expenses were outstanding. 5 million administrative expenses were outstanding. So we now have outstanding administrative expenses. Outstanding administrative expenses, and that is 5 million. These are the other payables we can identify from the question. Therefore, 5 million plus 5 million, then you have 10 million. So that means our other payables amounted to 10 million. So when you sum up your current liabilities, that is current liabilities, 234,000 plus 25,000 plus 10,000, then our current liability is totaled 269,000. 269,000. That is total current liabilities. Then You now sum up your equity and liabilities. Our equity, you know you have equity and liabilities. Equity is totaled 571,600. 571,600 plus the non-current liability is totaled 220,000. Non-current liabilities 220,000. Then we have current liabilities, which is 269,000. Then you have the total equity and liabilities to be 1,060,600, which agrees with our total assets. So we have total equity and liabilities, and that is 1,060,600. If you are just coming across this channel for the first time, or if you have not subscribed in the past, don't forget to click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. Thanks.